Hey everyone, Mortgage Nerd here. Gonna give you a bigger lesson for today. Unshaved, who cares? It's quarantine time. But this is really important because this could lead to a bigger mortgage meltdown, a bigger issue. And everything you're hearing from the government about the CARES Act is not coming to fruition by other government entities. They're just doing what they want. They're like rogue entities saying, we don't care. Let the banks fail. Let the servicers fail. That's really what they're telling us with what I'm about to show you. It's a longer video because I want to give you some understanding of all these different things behind me. So let's get into it little by little. Let's understand the mortgage process, period. All these little people, Joe and Jane Public, let's say. So the public wants a mortgage. You go to an originator. Now, it doesn't matter if you're a big bank on the corner of the street or you're a mortgage lender or you're a mortgage broker. When you originate a loan, you are the originator, period. The originator sells the loan typically to a servicer. Sometimes the originator is the servicer, at least for a short period of time, and then they might sell it to other servicers. But the point is, when this loan is originated, money is paid out, let's say 1% to 7%. There are some really greedy companies out there. You can tell by the high rates. That's money that's earned by the originator. They sell the loan to the servicer. The servicers now have the loan to service. They're going to send you a statement in the mail every month with their name on it. Here's your interest rate. Here's your escrows, all that stuff. They get paid for that. They get paid usually about 0.75% to 1%. It's a decent amount of money. So when people say to me, Phil, you think rates will get below 2%? No, because there's no money in that for anybody. My point is they make very little off of it year over year. So it's good. It's good business long term because that's every year. It's like residual income. What they do though is they don't really own the loan. They sell it to the secondary market. So now you're going to start hearing some familiar things. We all know about conventional loans. We all know about FHA. We all know about VA, right? All right, so let's break those off into groups. Those are just types of loans that are offered to you. So you can get a VA loan if you're a veteran. You can get FHA. Usually you get FHA if your credit is not as good. It's not a first-time home buyer program. There's first-time home buyer programs in all of these. But it's usually if your credit is not as good or your debt-to-income ratio is high, meaning your debts are higher than your income percentage or a percentage of your income than you would want with conventional, for example. So these are usually higher risk. Over here, usually these are the trouble loans, the problem children, so to speak. Conventional is typically the A paper, the high credit score, the big down payment, the one everybody wants to buy, the hot girl or hot guy at the high school dance, whatever you want to call it. These are kind of the nerds in the corner. I like this nerd. Fannie Mae and Freddie Mac, those are acronyms, not that word FNMA and FHLMC or something like that. And Ginnie Mae, GNMA, because it's Government National Mortgage Association, Federal National Mortgage Association, or this one's federal, I don't remember. The point is, this one is actually the only one that was always part of the government. Well, what happened? A GSE is a government-sponsored entity. So after the market crash, Fannie and Freddie were collapsing. So we bailed them out. Big bad bailouts, oh my God. $191 billion to bail out Fannie and Freddie. What the government did at the time is said, okay, well now you are going to become a government-sponsored entity, a GSE. So since then they've been government-run, government-regulated. And the government has profited from that $191 billion has turned into $301 billion. I think it's a good investment, in my opinion. Bail them out again because it helps the taxpayers. The same way the Fed is buying all these mortgage bonds, quantitative easing. Hello, they're buying bonds that they're going to profit from later. It's not a bad thing what's going on. It's a correction, and a correction requires some injection of liquidity, and that liquidity is going to get the blood flowing. Remember, the economy is like a body. The entire body needs blood to flow. If blood stops flowing, parts of your body start to die. The same in an economy. If parts of an economy don't get that flow, that cash flow, then it starts to die. But listen to what's going to happen to the mortgage market if this continues this way. FHFA, Federal Housing Finance Authority, I know it's a lot, led by Mark Calabria, regulates the GSEs, Fannie and Freddie. So basically what he says goes. Let's use our dear friend Ginny over here as an example. Rates skyrocketed on FHA and VA, and they're still kind of higher. Like I can give someone a VA rate almost similar to a conventional rate. I was talking to a veteran about that. I'm like, go with the conventional because you got a funding fee in VA. Anyway, the point is, the reason that happened is because everyone was afraid about the high risk. I want to say redheaded stepchild, but it might not be good for compliance, so just the problem child. So the problem children now actually have something called PTAP. I forgot what it means, but it means that Ginny Mae is going to step in. When a servicer gets a Joe and Jane Public of forbearance, so this person's not paying money, the servicer needs money. How are they going to get that money? These people are not paying, they're in forbearance. 6 months, 3 months, 12 months, they're not paying their mortgage. The servicer, remember, needs to make money to service the loan, to take all those phone calls. They're busy as can be right now to help people get forbearances. They need to pay the secondary market, the money they invested in your loan. This is a domino effect. Ginny says, don't worry, we are going to step in and we're going to pay that for you. So servicer, once they go into forbearance, we'll fund that money where Joe and Jane Public were supposed to be paying, and then they'll fix it later. Now, this gentleman over here, I hear he's a libertarian, which doesn't matter his political view, but it matters in how he views economics. A libertarian says, let the markets do their own thing. Let them crash. Let them fail. To a certain extent, I agree with that. But hello, we've been doing everything right. We've been doing everything right. The market was booming. We were doing well. $301 billion was earned because of the bailout. So everything's going right. We're being responsible. Yet he says, we're not going to help. Yesterday, today's Wednesday the 22nd. You're not going to see this on Wednesday the 22nd. But yesterday, I put out a video about how great, now they're stepping in. They say, we're not going to cover the first 4 months of forbearance. So guess what, servicer? 4 months, you got to figure it out for yourself. Then I said in that same video, the Federal Reserve was like the Treasury, you know, they have money, lots of money. They can step in and they can fund those 4 months. The Federal Reserve will pay those 4 months, right? Okay, so it seems like we're covered. Here's the problem. I closed someone Monday. The loan funds May 1st. Their first payment is not June 1st, but it's July 1st, right? They lose their job in May. They didn't have savings. Come the first payment, July 1st, and they have the choice, like I like to use the example of feed your family or pay your mortgage, and they have to make that decision, they're not going to pay that servicer. So get this. This is where it's like, what the heck is going to happen to the mortgage industry? If someone misses, if their forbearance is the very first payment, even though the CARES Act, the President, the Congress, and Senate all agreed that allow people to do a forbearance, do not count it as a default against them. But guess what? If you miss your first payment as a forbearance, that payment on July, if they're funding now in May, when they close, there's a 5 to 7% penalty, 500 basis point to 700 basis point penalty to these entities for writing that loan. How am I going to give you a loan and then you can't pay it because you got to feed your family and everyone is saying, don't worry about it, the CARES Act is going to help you, and you missed that payment and now we're charged 5 to 7% because this guy right here is saying, too bad, so sad, let the markets fall as they may. It's just a virus, it's no big deal, right? Wrong. That's wrong. This is going to lead to servicers wanting more money for their loans. So the servicers are going to charge more money, which means interest rates are going to go up, which means these refinances are going to go away, which means when people get out in the street again and they go to buy and we think the market's going to pick up, guess what? Rates are too high. Now we can't pick up on the economy. It's a mortgage meltdown in the making. I really think it'll be fixed, but we have to be aware of this and we have to go out and we have to talk to our Congress people, to our senators. We have to let them know, hello, this can't happen. We can't have these types of penalties because the government is saying that the CARES Act is going to protect mortgage companies from this. Yet we have entities like the FHFA that just doing what they want, going rogue, saying, too bad. So sad. Further, there's I think a $240 billion line of credit available to help fund these issues. Then after that, there's more money that could come in from the Fed, all these places. There's a lot of money, a lot of different places. People think we're printing money. We're not printing money. So that on other videos too. We have money. We sell bonds. We buy bonds. There's hundreds of billions and trillions of dollars out there in the government for exactly this purpose. This is what makes us one of the greatest countries in the world. Even though people say, oh, we're terrible. How could we vote this person and that person? Listen, our economic system, yes, it's capitalist. Yes, the billionaires are going to get richer. Yeah. But you know what? A poor guy, a poor kid like me can be successful and be a mortgage lender and hopefully one day a servicer in this country because of capitalism. So you're damn right this is the best economy in the world. Hands down. It has its issues. Nothing is perfect. But to date, all these centuries that there have been economies, this is the best one. And then you've got this happening, and it's like, come on, we gotta make this work. That's the end of my spiel. It's not a mic, but it's a marker. I dropped it. Mortgage Nerd out. Thanks.